All right. Hello, everyone. So we had a slight technical difficulties getting the stream started. So the link changed. So I'm going to give everyone a little bit of time to rejoin. Why is the... I don't know. All right. We will start here in probably 5 minutes. All right. Hopefully my audio is okay. We had a slight technical issue with the streaming. So thank you for everyone who is joining today. We'll get started here. So we're going to be talking about tax planning, hopefully how to pay less taxes for 2026 this year. As we go forward, my name is David Walston. I am the founder and the CPA here at Walston Advisory Firm. And let's go over some housekeeping items. So this session is recorded. Please use the chat for questions during the session. So as I go through the slides, if you have any questions, throw them in the chat. Something to know about YouTube: if you are not signed in, you won't be able to post questions in the chat. So make sure you sign into your YouTube account so that you can post questions. This is for educational purposes, so it may not fit exactly with your individual tax situation. So please feel free to ask questions if you have general questions about your individual tax situation, but don't put any specifics or private information into the chat. And then we'll share the resources after the session is over. So this is what we're going to be going over today. Our agenda is just a brief overview of what we think is the difference between filing and planning, why timing matters, estimated taxes, adjusting as income changes, and then some common things that you can do to hopefully affect your tax liability. Normally reducing it, but sometimes you might want to have a higher tax liability. You never know. And then next steps and Q&A. So the main difference between filing and planning, as a CPA, a lot of the work we do for our clients is compliance. And compliance can look like a lot of different things, from income tax filing to helping with audits or a bunch of different things. We just try to comply with different governmental laws for our clients and help them do that well, meet deadlines, and make sure they're in full compliance. But the thing with compliance is it is a reactive situation. You're not trying to plan into the future. You're just trying to take care of each deadline as it comes up and make sure you meet them correctly and file what needs to be filed appropriately, which isn't a bad thing, but we like to do our best to help clients look into the future a little bit more so that we can hopefully change things to see what where we can make changes, or what things we could push into the future, or what kind of tax liability maybe we can move, or what credits we could possibly apply for, things like that. And a lot of that takes the ability to take, sit down and talk about where you want to be, where you are going, and what things can lead you there, or what things can change. So we try to take a proactive approach with our clients if they will allow us, because this is being proactive takes you communicating with us and us helping with our specialized knowledge. One of the biggest things that we discuss with clients is timing. Timing is probably the most important thing when it comes to taxation, but in general in business as well. The goal is to try to time your income with maybe some expenses or credits that come in so that they offset each other, so your tax liability is lower. Or sometimes you just want to push it out in the future and take losses up front. So depending on what your situation and what you're trying to do, timing matters. And with this U.S. income tax system, it's annual. For businesses, you can change the tax period to a fiscal year, and sometimes that's helpful. Most of the time, an annual works just fine. But the goal is, in December, sometimes if you have things coming in, maybe you're getting a big commission check or something like that, asking to have it pushed into January is sometimes very helpful, because it gives you a full year to kind of figure out what you can do or plan for the tax liability that comes with it. So timing is a big thing for income and deductions. And once the year closes out, there's not a whole lot you can do. There are some retirement planning things you can do, but you have to get those accounts normally set up before the end of the year to be able to take full use of them. So making sure we understand what's going on and when we can place things is very helpful. All right. Estimated tax payments. Most people know what I have heard of them, but you may not fully understand why it matters, or if you should even care. And if you're a W-2 employee, most of the time you don't need to care, unless you have like a lot of stocks and investments, or you're doing some other things outside that W-2 job that might cause tax liability. Um, So estimated tax payments may not impact you directly as a W-2 employee, but it is something that you could update your W-4 for, so that your withholdings on your wage are more appropriate for your tax liability. The goal with estimated tax payments, at least from my perspective, the main goal there is to avoid any underpayment of tax penalty. The IRS expects you to pay a certain amount of tax throughout the year for the income you make. And if you do not do so, then you get charged a penalty when you file your tax return. So the easiest way to avoid that is through those safe harbor rules there on the right-hand side. And the easiest one is 100% of the prior year tax, or 99% of the current year tax. If you pay that amount, you'll avoid the underpayment of tax penalty. Did I not change my frame? I think I did. Yeah, we're good. All right. All right. So that's the biggest thing we try to avoid, is the underpayment of tax penalty. Part two of that, though, is it helps you with cash planning. So as small business owners, cash forecasting is probably one of the biggest things you can do in improving your predictability of cash flows. Is very helpful. So being able to plan ahead of time for how much you need to pay per quarter for taxes instead of paying one huge lump sum in April is helpful. The biggest thing with those safe harbors, though, is they're real easy to do when you have the same income year over year. If you do not have the same income year over year, then it becomes a little bit more complicated tax planning situation, where you might need to talk to us and figure out, okay, do I need to pay more? Do I need to pay less? If you're expected to make more income, some of our clients are like, well, I'll just pay the estimated tax payments, and then I understand that I'm going to have a large tax bill due at tax time, but I won't have that extra penalty because I didn't underpay. Sometimes that's okay. Some people like to up their payments as time goes as well. So kind of figuring those situations out if you have variable income is very helpful. So this really does apply to small business owners or self-employed individuals mostly. But if you are a W-2 individual and you have kids or other things like that, there might be some situations where either you want to make estimated tax payments or you want to just update your W-4 to increase the amount of withholding on your W-2H. Next up, common issues we see, of course, is payments, kind of going along with estimated tax payments, making sure if the amount of tax you're paying isn't correct or too low, that can cause issues with the IRS. Like I said, not only the underpayment of tax penalty, but you actually accrue interest as well a lot of times. So making sure that you're paying the appropriate amount of tax and doing it at the appropriate times is important. Irregular income not accounted for. So a good example I have of this is I have had clients in the past who have pretty good stock holdings and they wanted to do some home improvements, and so they sold a bunch of their stock, which is great. They made a lot of money off of it and they were able to do the home improvements, but they also had a large tax bill that they weren't aware of when tax time came around because I had no idea, so I couldn't tell them. So communicating that kind of stuff helps a lot, and so there are ways around it to either avoid paying tax completely or reducing the amount of income you have to pay taxes on. So those kind of irregular things, or you're selling a house or an investment property or things like that. One big issue I've seen with investment properties is people like to do 1031 exchanges, but if those aren't done appropriately and you only have 100 and something days from the start of the 1031 to the end of it to get it all done appropriately. If they aren't done appropriately, then you will have a surprise tax bill because it wasn't done correctly. And I haven't seen any of the 1031 firms that clients that I've worked with use actually inform them of all the intricacies. And so there's usually a tax due there. So make sure you're talking to your tax advisor or CPA about things like that so that they can make sure you're properly informed on everything and not just doing something because it sounds good and then not getting all the tax advantages of it. And then overpaying, underpaying. The overpaying is not as bad. Depends on how much. If you overpay it by a ton, then essentially you're giving a free loan to the government, and that's not great. If you're underpaying, we want to make sure if you're underpaying, you're avoiding the underpayment tax penalty. So making sure that all those things are taken care of appropriately is important. So with the tax plan, when I talk about planning, I'm not necessarily just talking about next year. I'm talking about 5, 10 years possibly. Depends on your situation. So if you're looking to retire in 5 to 10 years, there's some things that we can possibly think about doing. I don't know if any of you have heard about the Roth rollovers, but if you know what a Roth rollover is, if you have traditional 401k, then you can roll over funds into a Roth account, and that can be helpful because you're not required to pull funds out once you hit 70, 71 and a half or something like that. So there's no required minimum distributions, but it can cause a tax liability. So there's some things we can help with that. Or if you're selling your business, or if your business is starting to grow, things like that. So as things change, I'm not looking, I want you to think not just, hey, next year. I want to say, hey, think about 2 to 3 years out where you want to be, what you want to be doing, and then we can try to say, okay, the next couple of years, here's the things that we want to do to make sure we can reach that goal of yours. So as income changes with bonuses, business growth, all that kind of stuff, those are things that need to make sure we adjust the plan for. And same thing with expenses as well. And then as changes in law happen, like the One Big Beautiful Bill, there's definitely some advantages there, making sure you're fully aware of them and what changes might affect you. So some of the things we do is when we do tax preparation for all of our clients, we offer tax planning services in addition to that. And so you can sign up for those at that time. We also offer outside of that, if you didn't sign up for tax planning, you can just let us know and we'll set up some tax planning meetings with you as well. Mid-year check-ins are nice. At a minimum, we like to meet with our clients at the end of the year, if nothing else, October, November, to kind of discuss how the year's gone. But a mid-year checkup is a good thing too, to sit down with you to see where things are currently at and if you had any big changes. Making sure you get things updated with your estimated tax payments if you have them, or your W-4 or anything like that. So don't wait until the last minute. Do some proactive planning to hopefully save you some good money, and at least nothing else, save you some stress, because you won't have as many surprises. There's some times where the government will do things at the last minute. So some legal ways to reduce your tax liability. Some things that you can do. Um, uh, I'll try to give some examples here. So timing of income and expenses, that's the biggest thing I like to try to plan out. Is if you have a large tax bill or a large amount of income coming in one year, um, and you think it's going to be next year or something like that, we can try to give you some options of things you can do to offset that tax liability. As a W-2 employee, those are limited. Most of the time, you can throw money into a retirement account. The other thing you can do is an HSA account as a W-2 employee, and an HSA account can act like a retirement account as well. Once you get to the same age, 65 and a half, I believe, you can actually use it as a retirement account. And you can invest the funds in there and grow them tax-free. If you are just a W-2 employee, but you're willing to step your toe into real estate investing with short-term rental properties, those are some ways you can reduce your taxable income, because that is active income or active loss. We can help you with that. That's the biggest thing that you need to make sure you understand about tax law, though, is there's a lot of people out here offering solutions and things like that of how to reduce your tax liability. But there's what the IRS looks at for income wise is they look at active and passive, and you can't offset active income with passive losses. They have to be both active to be offset. And so if you saw something online or on TikTok and they're like pitching something and it sounded great, but it was passive, it was considered a passive activity, and it generated this great loss for you, it's not going to be able to necessarily offset that active income from your W-2 job. So making sure you understand that there are different categorizations of income and that they don't always match up. It's a very important thing to understand about tax rules. So just because someone says it online doesn't make it actually fit your specific situation. But there are things that you can possibly do. As a small business owner, you have a lot more leeway. The way to look at it is, if you're a W-2 employee, you're taxed on your gross income. As a small business owner, you're taxed on your net income, meaning your gross income minus expenses. And so because of that, there's a lot of ways in which you can reduce your net income as a business owner legally by purchasing items, assets, things you need. But the thing to be careful there of, I have had clients in the past who would buy a business vehicle every year just to reduce their tax liability, and well, that's not the best investment choice, because it's a one-time thing. Business vehicle, they can last 10 years or more depending on who you are, or at least 5 years. And so if you're buying a new car every year, that's not a good use of your cash. You're just burning money for tax reduction. And it would honestly be better if you just paid the tax. So making sure you understand that just because you can get a tax deduction doesn't make it the best idea, and then making sure that you time things correctly, like we were saying before. So if you're a small business owner and it's December 31st and you're like, actually do need some pieces of equipment and I was planning on buying them next year, might as well buy them that year. And that way you push the tax liability in the next year. With retirement accounts, those are probably the simplest way to reduce your tax liability. As a W-2 employee, those are limited to thresholds. I think it's like $14,000 you can contribute individually through your W-2 to a 401k. It's not a small number, but it's not as much as maybe a small business owner can, depending on ownership structure, how many employees they have, all those different things. So there's a lot of different things that you can do, but retirement contributions are probably the easiest. And then if you are a small business owner, there are structures that could help and benefit you. Sadly, a lot of times they're pitched as a cure-all. A lot of social media people will be like, if you set up an LLC, you can deduct things. That's not really how that works. Um, Deductions for businesses have to be ordinary and necessary for the type of business they are in. And so just because you have an LLC doesn't mean you get to deduct whatever you want. But structure can matter if your net income is high enough. And why that matters to me is if you have zero net income or you have net losses for the first couple of years, then setting up a more complicated tax structure isn't going to benefit you from a tax side of things because you're not making any income. And that's not necessarily a bad thing because most businesses that start out don't really make tons of net income. But as you grow, that's when it becomes, hey, you're starting to make enough income that we can make some changes that complicate life. Um, but that's kind of how it goes. So there are some elections and changes that can be very helpful. One of the best ones, if you qualify based on the services you offer and the type of business you are, is the qualified small business deduction, and that is something you need to plan for 5 years before you want to sell your business. And so that's going to take a lot of. It will cost you upfront thousands of dollars because we're going to need to get an attorney involved, evaluation of company, and all this stuff because we want to make sure that third section there that we're documenting and doing the proper record keeping so that in 5 years when you sell your business we have all the documents and everything to back up the nice deduction we're going to get you on that sell of the business. So there's a lot of different things we can help you look into, and if you do see something online that you want to ask about, you should. One of the most popular things going around right now is, hey, you can just hire your kid and pay them $15,000 and it's great. Not really. They actually have to work for you, and the work they have to do has to be paid a reasonable wage for their experience, and etc. Because the IRS knows about these loopholes, which they're not loopholes, and so especially when they're a well-documented thing, you don't want to do something weird where the IRS is going to be like, yeah, that's wrong. So make sure you have your documentation. Make sure you understand how the deductions work and are allowed so they can be done well and that you have support for when the IRS asks. So those are some legal ways. There's a lot more complexities. One of the things we look at with small businesses is the region of the state you live in. There's economic zones in states, and sometimes that affords you on your state tax return credits. But that's kind of the legal area that you have there. So what this means for 2026, the goal is for you not to have surprises. That is one of the main things we like to do with tax plannings is, if nothing else, if you know you're going to owe $10,000, $20,000, at least you know well beforehand and you can do some planning. You start putting money aside, put some savings and stuff like that, and you're not just surprised when we file your tax return. That is like the lowest hanging fruit of, hey, let's help you not be surprised. Part two of that is if you do talk with us, we can give you options. Now, every option has its risks and rewards, and some of them may not be something you want to go after, and that's fine. But we'll do the best to give the options we have available based on our knowledge of the tax code. The thing to know is there are a lot of scams out there, and there's some red flags you need to keep aware of when people are pitching tax savings to you or tax deduction to you. One of the ones I heard about recently is you donate funds and you get a tax deduction for that, and then they also send you a K-1 with loss. Again, that goes back to the active and passive rules. And then part two of that, that doesn't happen unless you are in real estate. And if you're in real estate, it only is deductible. The loss is only deductible if you are a real estate professional or it's a short-term rental. So there's a lot of things that go along there. And easy red flags for that kind of stuff is if someone's trying to pitch you a tax deduction and it sounds too good to be true, probably is. Part two, if they won't send you references to the tax code that supports that deduction, and they won't allow you to record their webinar, that's an issue. Our webinar will be posted live on our YouTube channel for anyone to see. So make sure you're keeping in mind obvious red flags and you're not just getting lulled into a tax strategy that has this big number of tax savings that actually isn't really legal and could get you in trouble. And then in there as well as cash flow, we want to make sure I can offer you a ton of tax strategies, and a lot of them are going to require you to spend money. And so sometimes that's just not the right thing to do. Sometimes it's better to conserve your cash, pay the tax so that your business has a better operating cash flow than to try to avoid some tax is by spending the cash. So keeping cash flow in mind is a big deal for small businesses. So what can you do? Review your prior year tax return. If you've never had anyone walk through your tax return, show you where things come from, that kind of stuff, it can be kind of boring. I enjoy doing it. Set up a meeting with me. I'd love to go through your tax return with you. Um, Going through your tax return can help you understand your income sources as well. So if you've got a lot of interest income, or you have some capital gains or dividends or other things beyond W-2, or you've got some different businesses, um, going through your tax return can help you understand that and what kind of things to look out for as the year goes on, to ask questions about. And then track changes early, like communicate, figure out what's going on, understand what things need to be communicated, ask lots of questions, and then, use us. We're here to help you. We've got a portal for you to upload documents and tools and things like that. So next steps, set up a mid-year check-in or an annual check-in or a quarterly check-in. Do some sort of tax planning through the year, whatever it happens to be. Um, you can do it with us. I'll have a QR code at the end where you can schedule a consultation. Um, but sit down with someone and talk through it. Um, Monitor income and payments. Make sure you understand if you're a small business owner or even just an individual. Budgeting is helpful. Tracking your income expenses is very helpful. Do that. Keep documents organized and communicate changes as early as possible so that you can so you can get that guidance on those major decisions, or get some idea of what the tax implications might be. As a reminder, this is just for educational purposes, meaning depending on your specific tax situation, things could be wildly different. So I wouldn't say that anything, there's tons of things you could do, but remember, unless we know about your tax situation, we can't give that individual advice. So seek that out. This is not intended as individual legal tax advice, etc. So I think that's all for today. Do you have any questions, comments? Let me know. All right. Well, if there are not any questions, we'll end it there. Appreciate your time. And here is my link for scheduling a consultation. You can give us a call, check out our website, shoot us an email. Love to help you out. Like I said, if you've never had someone walk through your tax return with you, I'd love to do that. So do it all through there. Thank you for your time.